I'm Dylan Marma, and you're listening to Operators and Allocators, a podcast dedicated to exploring how to make smart investment decisions and execute well in real estate and private equity. We'll be interviewing top-notch sponsors from various asset classes to understand how they think and the frameworks that they put in place with the goal of achieving above-average risk-adjusted returns. Welcome back to another episode of Operators and Allocators. This is your host, Dylan Marma, and today I am joined by John Cohen. John is a principal of Toro Real Estate Partners. He has sponsored roughly 4,000 doors of multifamily, over 20 different properties. He is a former financial advisor before getting into multifamily, and he is someone that I can certainly appreciate because I remember when I was first getting into multifamily about 5 years ago, he had the patience to entertain me sending him deals and giving feedback on those deals, and who knows how those things looked when I was first getting started. So I definitely have respect for that. So welcome to the show, John.
Dylan, thank you for having me. Excited to let everybody know, good, bad, the ugly, and anything I do to help.
Awesome. Well, tell us how you got your start.
So I started, I always had that real estate passion, right? It's always something that I think people are interested in. You first start by looking around like, buy that house, flip that house, or rent that house. But it was a little different for me. I was a financial advisor. And while I was doing that, I realized shortly after starting that, I was good at it, but I didn't love it. It was fun while you were doing it, when I was doing it. But at the tail end of that, I just started, ads started popping up on, whatever, emails about real estate and different types of real estate. So I got something in the mail about tax deeds or something in an email or an ad. And I basically said, this is pretty interesting. I can be a financial advisor, take my money and buy deals. And if I messed them up, it didn't really matter. Whereas as a financial advisor, you try and buy financial instruments that make your clients money, and then you make money as well. Even if they don't make money, you still make money too, which is not necessarily the best feeling. So I ended up just buying a ton of tax deeds randomly, right? You read a book, you go to an auction, you tell yourself you're not going to buy something, and next thing you know, you buy something for $380 and you feel, like, wow, worst case scenario, I lose $300. So that's how I started. I just basically, had that passion. It was always there, read some stuff, and just took some action.
How do you think being a financial advisor helped you get transitioned to this business?
So that's goes to maybe something that's going to come up later on. That's probably the one recommendation I make to everybody. I did it at this point. It's probably 15 years ago, right? It's been so long, or 10, whatever it was, and it taught you. I don't want to say the tenacity because that's already in you. I already had it, but that business, you go making 1,000 calls a day, 600 calls a day, working from 6 a.m. to 12 o'clock at night. You get to the office, you're calling Europe, then you call the East Coast, then you call Central, the Midwest, the West Coast, Hawaii. So you use your time in New York to pepper the entire world, and it's just call to basically be told no all day long. So when you take that and then you look at, if you take that success or that attitude towards real estate, you realize that you have more control. You're not selling Apple stock or Google stock or something that you have no control over. You could actually find what you want, and now you can go deliver that product, whether it's yourself, whether it's investors, whatever. So what it taught me was, I said, it's the best sales training in the world. And, the joke I tell, which wasn't a joke, it was 100% the truth. I sat down for the interview, and the guy's exact words out of his mouth, he said, if you're money motivated, this job's for you. If you're looking to cure cancer, I don't know if I can curse or not, but I won't, which I normally do, get the F out. And I was like, yeah, well, I'm money motivated. Let's do this. He's like, start on Monday. So that's how it started. So it was that attitude that parlayed it basically into that real estate, just taking that attitude of, don't stop, keep going, make the next call. And it was the best training you could possibly have when you just get thrown into the fire with, 1,000 index cards and a phone. And, if you came in late, you didn't even get a seat, right? You were standing all day. So you got there early to sit down. Or, if no one had closed the deal the first 2 hours of the day, our, boss would come out of the office, he'd take everyone's chairs away. So it's just,
Yeah.
shit like that you don't really see, on the real estate side. It's different. So that's, it was definitely the best thing I could have done at the time, because it taught you, basically, no's okay.
Mm-hmm. Yeah, I think that sounds like a great training ground to get your feet wet and get used to talking to people about money too, right? It's a pace setter, right? It's learning how to actually work, right? If you've never been in a competitive work environment like that, you don't know how much you're really capable of calls you can actually make in a day and have it be a productive day, versus if you're coming in unknowing and now you're your own boss all of a sudden, you may be much more lax because you haven't set the pace for yourself in that sense. And then two, you're talking about money all of the time, right? I think a lot of people come from families and backgrounds where talking about money can be out of the norm, and they don't feel comfortable approaching and asking people about their financial situations. Whereas in this case, you're working with investors all of the time. I'm sure that having that background in financial advisor space helped you better equip yourself.
All day. It was probably, the two things in a real estate world that you're always doing is finding investors and finding deals, right? Those are the two wheels that you're spinning. If you want to be the top of the food chain, you got to be able to do both, or you got to find really good people to do one or the other, and you sort of manage that process. Coming from the financial world, that's all you did, right? You were pitching ideas, shitty ideas for most of the time, right? That not good. Realistically, let's call it spade. You threw a dart at the board and it's like, oh, here, let's buy that stock today, right? Like that's the stuff. There was no analyst behind us when I first started, right? Then I went to a different company and it became more real. But when you first start, you're just throwing ideas. When you go to the real estate world, now you're talking to people. Now, one other, the biggest objection you got as a financial advisor was, I don't buy stocks, I buy real estate. So like that was one thing that, started that wheel spinning in my head. But you talk to these people day in and day out. Let's buy, Apple options. Let's play, earnings plays. And you start talking to people and you realize that you can get people to say yes to a really good idea that you have no control over, right? You were buying speculation. Here, it's different. So when you were able to bridge that gap and talk to people about something you believed in and that see tangible, feel it, it was totally different. So you're 100% right. Just having those conversations day in and day out, when you go on to the other side of the page, that was the idea I had. It's okay, well, I love real estate. I'm really good at talking to people and raising money. Let's just bridge it. That's why I went the other side, because I knew I was able to do it. And I knew that, I wasn't going to, someone said, no, it doesn't matter. I'll just go to the next person. Right. So you're 100% right.
Awesome. Shifting gears, what does your deal criteria look like today?
If I only knew that, right, I'd probably be able to give a better answer. I'd probably be able to find something. So we historically have been extremely opportunistic. We've bought 340 unit vacant deals. We've bought, completely vacant, low occupancy, tertiary markets. We did that extremely well for years. Obviously the market's been so hot that those deals have been few and far between. So I say that, and that's something that we still have a passion for, something that's really messed up that we could come in and just add value by operating it better, marketing, leasing, renovating units from classic units from the 1960s, 70s, 80s to 2020 plus. That's what our bread and butter is. And we love that. We will look for those opportunities all day long. Those could be 100 plus units, 200 plus units, solid MSAs. The biggest change is I don't really want to be in a tertiary area. I'd rather be in a much better location. Also mobile home parks, same thing. Mobile home park could be cash flow, could be heavy lift. In a perfect world, it's a heavy lift that does have some cash flow. That's the attractive part about that. But we've seen ourselves gravitate towards newer vintage, and not 2020 built stuff, but instead of that 1960s, maybe 1980, 1990, 2000, because what we've seen in today's marketplace specifically is that your older vintage deals are selling for prices that never made sense. 5 years ago, you could buy that property for 25, 30 a door. Now they want 130 or 100 a door. So if you're going to spend money, I want it to be, A- location plus, or B+ A- location and B product, not necessarily war zone product in a marginal area. So I think the biggest shift for us is great piece of dirt, buy it right. And then, the pricing, not so much, I say pricing, not as important, but you got to buy the good piece of dirt in a good location, and then you can pay for it. That's probably the biggest the biggest shift. But behind that is going to be, really solid construction, probably a little bit of a newer product, not so much 1960s stuff. I like more 2 and 3 bedroom mixes than I do 1 bedrooms, just from a standpoint of they command a higher rent, they cost the same to operate. Now we do have some product that's a little bit different than that, but in a perfect world, that's what we like. We want that really good B+ workforce housing in solid A locations, which I think everybody wants, but that's the perfect world. Other than that, it would, like I said before, it'd be that super opportunistic stuff, vacant property, really dilapidated, heavy deferred maintenance, long-term sellers. That's the stuff that everybody looks for, everybody wants it, but you can't make a mistake on those or those deals hurt.
What you're mentioning here, I think, is a theme that is pretty common across operators when it comes to today's market. It seems that while cap rates have compressed in virtually all classes, A class, B class, C class, it seems that the C class, the old heavy lift, heavy value add, ugly product, those type of deals have compressed faster than the A class, right? An A class in certain markets may have went from 5 to 4, but it also might have went to 7 to 5 on the C class side of things, right? So why do you think that happened?
I think chasing yield is the biggest thing, right? People want to make returns, right? You can't buy, treasury bonds and all of that stuff for the amount of money that was printed recently. Those investments are nearly non-existent. There's not, you can't, that stuff doesn't make money. So people are now willing to throw caution to the wind or turn the page on that stuff where they feel housing is extremely satisfying. And, the rent laws change, COVID laws change, where a place like New York, the rent stabilization laws are atrocious now. So you have a ton of investors coming from states like California, New York, that are now going to areas that we were buying in 6, 7, 8 years ago. And they're saying, wow, I used to get a 3 cap in New York. I could buy a 4 cap here. Great, let's do it. So it's so much, there's so much capital chasing deals. An A-class property is an A-class property. It is what it is. A C-class property, people see value in that, saying, okay, I can turn this into more. The problem is the pricing. The cap rates have gone down so much and the values have gone up so much, that deal has inherent risk, because if something goes wrong, that property's going to get hit first, right? If the world goes upside down, yes, A-class properties, people lose their jobs. Those tenants may or may not be able to afford it. When a C-class property goes wrong, it's all your HVACs are shot, your roofs are shot, your plumbing is shot. That doesn't happen in A-class stuff for the first 5 or 10 years. In a C-class property, if you have to do all new roofs, all new plumbing, all new electrical, all new HVACs, and your rent is $1,000, $800, $600, good luck, right? If you don't budget for that property up front, it's over, right? That deal just won't make money. Now, you might make money 10 years down the road if you can sustain it, because long term you typically don't lose, but it's going to hurt for your life of ownership. So you got to really understand that component of it. So we have no problem. We bought vacant properties. There is no cap rate on a vacant property, but we knew that the cost to construct and what the finished product would look like, the numbers worked. So it's just, I think there's a lot of people chasing deals, and when the institutions and the private money and the those big bucket equity groups start coming into the secondary markets, it pushed the professionals into the tertiary. And now what was a professional in a secondary market is now the king of the tertiary market. So they can do different things. And when you have new investors getting involved, they make those mistakes. So where I may pay $80 a door for a property in Jacksonville, a new investor may say, well, no, I could pay $125 or $105 or whatever it is, because they don't have the history of what it really costs to replace roofs, operate it, salaries going up, insurance is going up, taxes are going up, right? These are things that people miss, which is why they, sometimes can hit higher prices. So I think all of that's the perfect storm on why you've just seen, 5 caps go to 4 caps in A class, but 7s go to 4.5s in C class. It's just been a perfect storm of everything that's out there.
Yeah, there's a lot of unknowns with the C class that if someone is inexperienced and they haven't taken their lumps yet, they're seeing through these rosy lenses. And then, like you're saying, they start to have the utility issues, they start to have the HVAC issues, and all the deferred maintenance catch up to them. And it takes experience, and there's really no other way you're going to learn that besides seeing it and feeling it when it happens, because it's painful. And then you're going to be a little bit more gun shy, paying a crazy price on the next go around with that same sort of class of a property. What do you think are the biggest risks or red flags that you try to watch out for?
Yeah. So the biggest thing right now for us is sticking to what you know, right? It's not trying, I don't mean like, oh, I'm not going to buy an office building if I don't know what I'm doing. I'm talking about the fundamentals of real estate, right? Great location, great basis. If you check those two boxes off, you probably don't have any worries. You might not cash flow, but you'll be fine. The biggest risk I see is that real estate is such a not technologically advanced industry. It's so antiquated. As technology is getting better, as people have more access to things, it almost blurs the lines of what used to be the guy in the country club would buy these deals and offer it up to people. Now there's 50 different websites where you could crowdfund a deal, or I come together with 6 of my friends, we're all the principals, and we all raise $1 million and we all buy this deal, but we've never really done deals together. The long-term sustainability of random partnerships coming together to do deals. If something goes wrong, real estate is not a day trade. You could just sell it tomorrow. Now, technology may try and make it that, and there are things that are happening, but for the most part, you're in it for the long haul. So, it's not an instant divorce. It's a long, nasty divorce when things go south. So that's where I see the biggest risk, is that the uneducated or people that don't know as much go in heavy and hard, and they sort of skew things. So if in a perfect world nothing bad happens, but if something goes sideways, there's going to be a lot of hurt, and that's probably where I see the most likelihood for downside. Now, on the flip side of that, the economics and the demographics support housing. So I think that it'll blur a lot of things, but that's where, we stay strict to what we know and we don't deviate. If we lose a deal, we lose a deal, but we're not going to get emotional about it.
I think that's huge. I think a lot of people undervalue the manpower that it takes to operate real estate, and partnership risk can be a huge thing. Operator risk can be a huge thing if you're investing passively. Those are some of the things that really throw a curveball. If you see some of these completely dilapidated portfolios, a lot of the times it's because there's at the top of it, it's people issues, not actual real estate issues, that are the cause of all the deferred maintenance and the shit going on with the property. So completely agree with that. You say, you mentioned good location, good basis. And I think when I look at a lot of operators, I think that you probably put a lot of weight on the price per door going in, right? And how that correlates with the rest of the market. When you're looking at value add deals, are you typically looking to be within a certain percentage of what the fully stabilized stuff is trading at? And how much weight do you encourage investors place on looking at where stabilized assets sit and the price per door things are trading at?
Yeah, so that's probably the biggest factor what has the real estate. That's why the price, that's another reason why the pricing has gone crazy. Class A construction, is selling for $200,000-300,000 a unit in markets. There's a 1980s built deal in Jacksonville that just broke the $200,000 a door number, which is crazy because 3-4 years ago you could buy Class A construction for that price. So price per door is important, but the bigger thing for us is I don't want to have to be the highest rented property in the market to achieve my numbers. I want to make sure that I can take the in-place market rents to market where I win, and not take my in-place rents to market. And that's, if I don't hit that, I lose, right? I want to be able to win when I buy it. And that doesn't have to be 12% cash flow and a 30 IRR. You win if you can cash flow 4 to 8%. And if you can cash flow that, and then as you increase your occupancy or your rents, or you fix problems and add amenities, if you can take that to an 8 to 12 cash flow and maybe, a mid-teens IRR, 12 to 16, that's good. That's what you want. You don't want to have to hit everything to be, a lower end of that target, right? Because, I tell people all the time, if everything has to go right for you to win, you're going to lose, because nothing ever goes right. So you want to, you don't want every single thing to have to work to win. You want one thing to work so you win, and then all that other stuff is, icing on the cake. So if you can do that, that's the most important thing. So whether it's a price per door or whether it's, 20, 30% below Class A rents. However you look at it, those are the things that you want to understand. You don't want to have to pull every single lever for the deal to work. You want to be able to say, okay, the occupancy 70. If I take it to 90, we win. Now, if we can get an extra $200 in rent, fantastic. So that's typically how we look at things. And when we buy things, we want to see that. If everything in the market's renting for $1,000 and we buy a deal at 800, the average rent, we know we could take it to 900 and we're going to be a really good affordable option for everybody in that submarket. Doesn't mean we're not going to try and get 1,000 or maybe even 1,100, but we know at 900, 950, we're still below everybody and the deal's going to work, whether that's A, B, C, quality construction or location. But in a perfect world, like we spoke about earlier, you want, a better location and you still find that metric that works for you. And that's all return driven, risk driven, stuff like that. So we may say we want to be 30% below Class A, where someone says, no, I'm okay with the risk of 10% Class A and I can pay for that. So as long as you understand that, I think that's the most important thing, not necessarily price per door, construction cost or replacement cost. That's all well and good, but understanding, what you're looking to accomplish is probably most important, and finding that property where you want it to be. And that's most likely the recipe that will work.
Yeah, what I hear is that it sounds like you take a holistic approach and you're not looking at exclusively price per door or where rents are relative to the market or what the exit cap is. You're looking at all of it combined and trying to make sure that you're not relying on, like you said, all lights to turn green at the same time to be effective. You probably build little bits of buffer in to say, do we like the deal if it hits 75% of the rent increase possible? Can we live with it if it trades at 50 basis points of a higher cap rate than is possible in today's marketplace, or something along those lines, right? So I think that's great advice. When you're looking at, I'm sure this isn't a completely binary answer, but when you're looking at, say, one of those C-class heavy lift deals, low occupancy versus, say, a B-plus deal that's got maybe some rent increases in the mix, what kind of difference are you typically targeting? Are you targeting, mid-teens IRR on the B class deal and 20% on the C class? Is it an equity multiple you look at? How do you sort of separate the two of those in your head?
Yeah, so I can go to bed at night not having heartburn, right? That's the measure for us internally. It doesn't necessarily, when you buy a C class deal at a low teens IRR and a B class at a high teens, of course you would. But for me, what's more important is that I go to bed at night and my investors are okay. The deal's going to do what I'd like it to do, and the returns match the risk. I'm not going to buy a completely vacant property in the middle of nowhere for a high single digit return. It's just, that doesn't make sense, right? You could go buy that almost anywhere else. So that's the biggest metric for us internally, knowing that I can, whatever I put out there and whatever we buy, it's not, the risk is worth the reward. So it's not necessarily a return metric. It's not necessarily, because investor expectations have to change as what's going on goes on, right? The days of 20, 30, 40s are harder to find than what they used to be. But I think it just comes down to an appetite for risk, right? If the risk is worth the reward, it's great. So maybe it's a lower price per door, but the return might be the same, because a lower price per door is probably going to give you a little bit more insulation to problems than that. So I don't necessarily think it's return driven. It's more opportunistic risk. Juice is worth the squeeze, right? I'm not going to get involved in a deal. What we were talking about right before we started recording, right? I'm not going to buy a deal that doesn't have enough in it for all parties, myself, my investment, my partner, my partner's investment, and all our investors' investment. It's got to be worth it to go into it. So we might look at a deal that's got a super, super high ceiling, but we know if we fail, we're going to at least get to the next floor. We're not going to go underwater, right? So that's probably the most important thing when you're going through the whole spectrum of risk, reward, class, type, vintage, location. You want to make sure that you have your own internal checkpoints to say, okay, I'll buy an A class deal in an A plus location. This is what I need to achieve. And it's not necessarily return, it's peace of mind, right? Don't buy a deal because it's a 25 IRR and it's a great deal and it checks off every single box if it's in an area you have no desire to travel to. So, it's got to all work for us to move forward. So if it's not the best location, but it's a great return, got to get comfortable with that, because you're going to have to go there. You're going to have to check it out. You're going to have to do things you don't like. So what I would rather do is do stuff that I like and enjoy while also winning. So that's probably the most important thing for us. And what we put out there is that, the risk is worth the reward, and you can go to bed at night knowing that you're doing everything you can to achieve success.
Completely. I think that's very well said. And I know for myself, I've made it a point, if I feel like my life's at risk or I'm going to get shot walking onto a property, it's not worth it. Just no matter how good the return looks, I'm just not willing to do it.
I've done it, right? When I first started, when I was buying those taxi properties, I used to knock on the doors like this because you had no idea. There were multiple times where a guy came out, and it was a compromising situation, right?
Yeah.
Or, you're looking over your shoulder. I'm in the wrong place at the wrong time. The deal might have been great. It might have been fantastic, but is it worth it day in and day out? That's something that everybody has to ask themselves. So I agree with you 100%.
What's one unpopular opinion you hold?
Right now, maybe this is, too easy of an answer, but I think, I don't think people realize things can go wrong. Everything out there is so positive. There's negatives out there too, but you talk to people complain about pricing, and they complain about deals, and they complain about velocity and buying and investors, but yet there are deals that are transacting all day long at price and stuff like that. So I think a lot of people out there see the good stuff and talk about, oh, there's a shortage of housing, there's a demand for housing, so much can go right. There's also other stuff looming out there that I don't think is talked about enough. So I just think that it's the side of that people don't want to realize that something can go wrong. I think that people always think about it, but they probably throw caution to the wind. So I don't know if that's a good, maybe it's too easy of an answer, but that's where I see is the biggest, problem.
I think it's great for people to hear that from someone that's been through the ringer enough times. If someone that's new listening, they need to be able to take that same kind of perspective. And that leads me to a question I always like to ask, because we all want to learn from our own mistakes, but it's always better if we can learn from the mistakes of other people. What's one painful lesson that you've learned that you feel is worth sharing?
You got to read everything, right? We've done some deals and we've looked at some stuff, and maybe you signed a term sheet and you shouldn't have. Maybe you didn't read the fine print. Maybe you trusted your attorney a little too much. So I think that, a big mistake that a lot of people make, we've made it. Some of it has hurt. Some of it has been, oh, thank God. But I think you've got to understand what you're getting yourself into, right? An operating agreement as an investor is the perfect example. We have deals where I look back and I'm like, okay, why'd I put that in there, right? And things go well, nobody complains. And I know it's not going to be perfect all the time, whether it's a term sheet from a private equity group, whether it's a PSA where it talks about, right of survivorship if they don't do something right, or read everything and understand it and really, sleep on it before you make a decision. Because those things matter when things go south. So I think that's probably the biggest mistake that people make is, the trust component of what's out there and the conversations that people have. And the document doesn't always correspond to what was said. So I think as long as that is understood, I think that a lot of people can save themselves a little bit by just understanding. You don't have to know every single piece of it in the legal side of it, but you want to at least ask the right questions and understand the concept behind it, and then execute on the concept and make sure the words match the concept and not the concept match the words, or whatever, vice versa.
Yeah, that's powerful. And I definitely can't emphasize that enough, because when we're excited, it's so easy to go sign the operating agreement. Don't even look at it, just sign it and let it go. And then you signing a PSA is the same thing. As long as it's got all the basic points, you can just quickly sign and move on without dotting your I's and crossing your T's, and really reading it and understanding it, because it slows things down, right? You're trying to juggle so much stuff. You're trying to raise capital. You're trying to put the deal under contract. Maybe you have another deal you're trying to sell all at the same time, and you're getting hit day in and day out with contract after contract. So it's fatiguing, and it can be so easy to just take the passive approach of just signing it and moving on. But those things, the instances that you want to kick yourself down the road because you were too lackadaisical about it in the first place.
Absolutely. The one thing that is definitely not a mistake is getting involved, right? If you buy something and it's not the best deal, or it turns out to go sideways, that sucks. You can overcome that stuff, but when you make a mistake and you're not paying attention, that's what hurts going to bed at night, right? Buying something you thought was going to work, not as big of a problem. But when you do something and then you question it, that's the stuff that you can easily avoid by stepping back, reading it again, and then asking the right questions. So I agree 100%. There's nothing wrong with going out and buying a deal and failing. That happens. That happens to everybody. But when you second guess yourself and you don't ask the right questions, that's the one that hurts because you can't unfix that.
Tell us about operations. What's your secret sauce?
So this goes almost counter to what I just said, but I think that, you know, this secret here is that you got to have people empowered to make decisions. And real estate, there's a level of trust you're just going to have to get over. Unless you physically plan on doing everything yourself, from fixing a toilet, leasing an apartment, running a credit check. If you don't do it all yourself, you've got to have people that are willing to make the decision and own it. And you have to be okay with that decision. If you don't, you're probably getting involved in the wrong thing, or you're going to be the guy that's doing everything. Nothing wrong with that. But if you want to operate 2,000, 4,000, 10,000 units, you're going to need to leave controls to other people. So as I just said, you know, make sure you read everything twice. I think what we've done really well is that empowered people to make decisions, knowing that if they make a mistake, they own it, and then giving them that flexibility. I don't want to say give them enough rope to hang themselves, because that's not necessarily good, but you want to make sure they're making the decisions that have to be made in the critical times and getting the answers if they don't know something quickly. So if someone understands that, and that's the most important thing that we do, is put people in control and put people in the position to succeed, as opposed to putting people in the position to fail. And I think if you do that, you'll inevitably be more successful by allowing people that position, but also staffing and hiring and firing properly, so you put the right person in that seat so you don't make that mistake. But if you don't know an answer, get it. But at the same time, making sure that people have that decision control is super important, and the level of trust has to be there. Or if you don't trust that person, then you can't do it, because there are things that are going to come up that aren't going to go 100% according to plan, and it's got to be an open book. Don't hide anything. Say how you feel right away and turn the page and get back to the business plan.
Love it. You've worked with a lot of third-party managers, I believe probably 5 or 6. You can give me the exact number. Yeah, I'm sure you've seen the good, the bad, and the ugly on that side of things. What are best practices for finding quality management?
Referrals are the easiest way, right? You're right. We've worked with great managers. We've fired great managers. We've fired managers and then kept them on other properties because they didn't execute on one deal, but they've executed on other deals. The biggest thing you can do is the 3 tips that I give anybody is, when you're talking to brokers and you're talking to owners in the area, ask them who they use and who they recommend and who their clients use. Those 3 questions will give you, it'll sort it from 100 potential options to 3, 4, 5. Then it's getting into their wheelhouse, getting into their face, and really diving into their operations, right? I want to see your properties. I want to understand your operations. And I want to see, what happens if what happens if you're not there, right? What are your decision controls? How does someone, do they always need to get your approval, yes or no, or understanding that? But referrals are the best because they typically come from people you trust. And there'll be a double introduction. You ask me, I say I'll make an introduction. If I have a good relationship, that person probably takes you a little bit more serious. But and then just keeping a close eye on stuff, right? Like I said before, you got to have a level of trust, but you also got to read everything. Making sure you can't teach an old dog new tricks. If you want them to operate a certain way, but they are hell-bent in their ways, it's a relationship that's going to start off rocky. If they're willing to be flexible and work with you or educate you on why their way may be better, understanding that out of the box and making sure that you're always on the same page day in and day out on the business plan is the most important thing. So referrals are probably the best. Talking to other people in the marketplace, and then just touring deals, right? If you're in a marketplace and you're driving a deal that looks horrible, find out who the manager is. If you're touring a deal that looks great, find out who the manager is. And at the end of the day, you got to spot check, right? You gotta spot check the groups, right? Let them tell you something. A week ago, 2 goes by, a day or 2 goes by, spot check them, see if it's accurate, right? They tell you, oh, we respond to all tenants in 24 hours. Wait 3 or 4 days, get on the website, pretend you're a tenant, see if they actually do that. So you got to check what they say is actually factual. And then you could start building that relationship. But I would say introductions are probably the best because, we've gone through a bunch. We have ones we like. We have one right now that is probably our favorite. They do things that, everyone's not going to be perfect. But at the same time, when they make a mistake or something goes wrong, everybody admits it and you move on. And that's probably the most important thing.
Property management is an extremely tough business, and I can't stress the importance of doing heavy diligence on the front end there. But a lot of it you will have to learn through trial and error until you find the right
100%.
fit, right? So
there's no secret magic that you can do that'll make it fail safe, right? You're gonna have, it's the candle's hot, don't touch it. You got to get burned, and then you learn from those mistakes. That's the only way to go about it.
What is it that motivates you today?
Family. That's the easy one for me. I was the greatest childhood you could possibly ask for. I want to be able to provide that for my family, not only my wife and kid, but also parents, because what they were able to do for me, hands down, why I do what I do today, so I can give back to them as they gave to me. Without that, you're just going through the motions. It's not a dollar amount. It's not a car, a house, a location. It's irrelevant. You got to be able to go to bed, know what and why you do it. And that's the answer 100 out of 100 times.
Completely. I think it's really important to have a really clear why beyond just the dollars at the end of the day. So give us the best practices for those that are active operators seeking to find their first deal, and then best practices for passive investors that are interested in passively investing into multifamily or MHP.
So finding deals, you got to pick up the phone, send emails, don't stop, because you got to remember, when you stop approaching owners, brokers, wholesalers, whatever product class it is, there's somebody else out there that is going to continue to do it. So you got to make offers, you got to get out there, put yourself out there. You got to put yourself out there. You got to put your neck out there and ask, or nothing's going to happen. You're not going to wake up tomorrow with a deal on your desk, right? Or you're not going to wake up tomorrow with a deal under your pillow. It's not the tooth fairy. You have to go get it. So the best thing you could possibly do is, it could be, I'm going to make 2 offers a day. I'm going to call 2 people a day. I'm going to call 10 people a day. Just make sure you stay consistent and keep doing that, because like I said, you're not going to wake up with a deal under your pillow. It just doesn't work that way. From an investor standpoint, I think the most important thing is you're not investing in the deal. Every investor listening, you could call my bullshit, say, no, I'm investing in the deal. You are investing in the person running the project. That's why you invest. Because if I sent you a deal and someone else sent you the deal with the exact same return, why are you going to pick? Don't tell me it's because it's in Florida and it's next to the beach. You're investing in the behind the scenes. So as an investor, understand what is behind the scenes, because that's why you make a decision, whether you know it or not subliminally. You're investing in the operator and their ability to execute, not in the property. Okay, yes, I'll probably get hate and people say that's not true. People invest in the property, but at the end of the day, they're investing. That property can fail with the worst operator, and with the best operator, it'll be the best property in the world. So at the end of the day, just because you invest because you like the deal, the operator is going to be the success of the deal. It's not just going to be the deal. So as a passive investor, understand who the operator is and what they're looking to deliver, because it'll give you a much better investor experience than I just wanted to buy it because it showed a 35 IRR or whatever it looks like. That's typically not why I would invest in something.
Awesome. Definitely second that. I think it's super important to be investing in the operator first. And that's probably more important when things are going south, right? When things are going good, everyone looks good. But when things are going south, it's the people that are willing to be proactive and take a hands-on approach that are going to be the ones that pull through the best at the end of the day. And that's how you really build long-term.
You're spot on. The last 3 or 4 years, or last 7 years, 8 years, has masked a lot of mistakes. Operators either know they've made them and they've been successful and they won't make them again, or they're blinded to them and things haven't gone wrong yet. So people don't know. But you're right. When things go bad, it's the operator that you need to, you got to get on that boat and go. It's not the deal, because a good deal with a bad operator is a bad deal. A good deal with a bad deal with a good operator is probably going to be a good deal.
I know you have a podcast and you're pretty active with that. Where can listeners find you online, and how can they plug with your podcast?
Yeah. So the best way to find me, send me an email. I am not the greatest on social media. We just had a conversation about getting I have all these podcasts recorded and all these snippets, and starting to get on TikTok, which I think I downloaded the other day for the first time. So I am not a good social media, but my email address is John, John at Toro, TOROREP.com. You could shoot me an email there, or if you go to our website, ToroREP.com, there's an investor questionnaire. You could fill that out with questions, comments. It'll bring up a link to book a call, a one-on-one with me, where you could, it could be I want to invest. It could be I have questions. It could be anything. Email or website's the best. Or, you can listen to our podcast, The Real Estate Investing Experience. There's a website. It's on all the podcast platforms. Any and all of that, right? Reach out to me. I'm willing to give anybody the time. You got to be proactive, and you got to reach out. If you reach out, I'll give you the time, because it at least shows you took the initiative.
Awesome, John. Thanks so much.
Thanks for tuning in and joining us on another episode of Operators and Allocators, hosted by the Requity Group, a vertically integrated private equity real estate company. You can find recordings of all shows along with other resources on our company website, therequitygroup.com, also listed in the show notes. A brief disclaimer to our listeners. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. All investments are subject to risk, and past performance is no guarantee of future results. The views and opinions expressed by the Requity Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions. We hope to see you next week.